Looking for a good deal on a high quality stock? Want a yield that's almost 3 times higher than the broader market's yield? Would you like exposure to one of the best selling products in its entire industry? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel, and I'd really appreciate it. And make sure to stay tuned until the end of the video for a special news announcement. I want to tell you about a high quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is a pharmaceutical company selling medicine to millions of people. This company is part of what's commonly known as Big Pharma. Think about that for a second. How did these companies become so big? Well, that's because they practically print money by providing more healthcare products to more people at higher prices. And with the world growing bigger, older, and richer, you know what that means. More profits and more dividends. I've personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. By the way, I explained exactly how I achieved financial freedom in just 6 years in my early retirement blueprint. If you're interested, you can download a free copy of my early retirement blueprint using the link in the description of this video. Getting back to the stock I'll tell you about today though, perhaps best of all, it looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of Merck Co Inc., which appear to be trading at a significant discount today. Merck Co Inc., stock ticker MRK, is a leading global pharmaceutical company that produces a range of medicines, vaccines, and animal healthcare products. Founded in 1891, Merck is now a $193 billion by market cap healthcare behemoth that employs nearly 75,000 people. The company operates across 2 reportable segments: pharmaceutical 90% of fiscal year 2020 sales, and animal health 10%. Insignificant sales occur in unreported segments. Their core areas of focus are diabetes, infectious diseases, oncology, vaccines, and animal health. The US is the company's largest market, accounting for over 40% of worldwide sales. Some of the company's key drugs include Keytruda, Januvia, Gardasil, and ProQuad. Keytruda, their Marvel cancer drug, is the company's most important product. It's by far the top-selling drug in their portfolio. This single drug made up almost 30% of the company's worldwide sales for fiscal year 2020. That compares to nearly 25% of company revenues for fiscal year 2019. What's exciting about Keytruda is that it's becoming a larger piece of a growing pie. The company's top-selling product is also one of its fastest growing products. Also, Keytruda isn't only Merck's best-selling drug with almost $15 billion in sales for fiscal year 2020, it's one of the top drugs on the planet, second only to Humira. The anticipation is for it to be the best-selling drug in the world within a few years. Based on recent growth, that seems highly plausible. Keytruda sales were up 30% year over year for fiscal year 2020. Notably, this drug is on patent through 2028 in the US and EU. Now, the Merck of 2021 looks slightly different than the Merck of 2020. That's chiefly because in June 2021, they completed the spin-off of certain non-core assets into a new company called Organon & Co, stock ticker OGN. However, this will have an immaterial impact on Merck. Organon has a market cap below $10 billion, which is less than 5% of Merck's market cap. Merck's business model is highly lucrative and highly appealing. After all, global demand for and access to quality healthcare is sure to increase over time. The world's population is becoming larger, older, and wealthier. Merck has powerful demographic tailwinds blowing its way. That should translate into more profits and bigger dividends. The company has already increased its dividend for 10 consecutive years with a 5-year dividend growth rate of 6.3%, which comes on top of the stock's yield of 3.4%. The stock offers an appealing combination of growth and yield. This market-beating yield, by the way, is 50 basis points higher than the stock's own 5-year average yield. And the payout ratio is a low 47.1% based on this year's guidance for adjusted earnings per share at the midpoint. It's a well-covered dividend. I like dividend growth stocks in what I refer to as the sweet spot. That's a yield of between 2.5% and 3.5%, paired with a high single-digit or better dividend growth rate. The dividend growth rate is on the bubble, but the yield is at the high end of that range. Looking at business growth, Merck's revenue is essentially flat between fiscal year 2011 and fiscal year 2020, moving from $48.047 billion to $47.994 billion. However, it's important to keep in mind that Keytruda didn't come on the scene until 2015. Merck's revenue is up more than 20% since fiscal year 2015. Meanwhile, earnings per share increased from $2.02 to $5.94 over this 10-year period. That's a compound annual growth rate of 12.73%. I will note that I use adjusted earnings per share for fiscal year 2020. That's because fiscal year 2020 GAAP earnings per share included acquisition costs and intangible asset impairments that aren't reflective of the company's true earnings power. Excess bottom line growth was largely propelled by significant share buybacks. The outstanding share count is down by almost 18% over the last decade. Looking forward, CFRA forecasts that Merck will compound its earnings per share at an annual rate of 10% over the next 3 years. This is a reasonable assumption in my view. It's also highly compelling in terms of the investment thesis. Merck's pipeline is robust, with 53 programs in Phase 2 and 25 programs in Phase 3. The company has time to develop programs because of the multi-year runway for Keytruda. Speaking of that runway, CFRA notes this, and I quote, "We see a favorable setup for Merck, with no key brands losing marketing exclusivity until 2022, and Merck's growth engine, Keytruda, on patent until 2028. We also expect Keytruda to grow on further uptake in existing cancer indications, as well as potential for longer-term approvals in major indications, such as breast and colon cancers," unquote. I don't see CFRA's forecast as a high expectation for Merck based on recent results, and this would support like dividend growth, so that's high single-digit dividend growth potential on top of a 3.4% yield. I like that. Moving over to the balance sheet, the company's financial position is solid. The long-term debt-to-equity ratio is 1.0, while the interest coverage ratio is over 11. Shareholders' equity has been artificially lowered by treasury stock. That's due to the aforementioned buybacks. This pushes up the debt-to-equity ratio, but the balance sheet is highly satisfactory. Profitability is quite robust. Since Keytruda's arrival, there's been a pronounced margin expansion. Over the last 5 years, the firm has averaged annual net margin of 14% and annual return on equity of 20.6%. Merck is perhaps in the best position it's ever been, and the company does benefit from durable competitive advantages, including economies of scale, a global distribution network, patents, IP, and R&D. Of course, there are risks to consider. Regulation, litigation, and competition are omnipresent risks in every industry. Patent cliffs are always a risk with pharmaceutical companies, although Merck is in the midst of a favorable patent period right now. Keytruda might simultaneously be the company's biggest advantage and disadvantage. I say that because it's starting to become an overwhelming portion of the company's sales. This linchpin drug could weigh on the business and stock in the future after patent protection comes off. Any changes to the complex U.S. healthcare system would likely affect Merck. All pharmaceutical companies have pipeline risk. The pipeline is pressure to produce successful drugs in order to support sales, rationalize R&D, and mitigate patent cliffs. With these risks out in the open, I still think Merck could be a great long-term investment for dividend growth investors, and that's particularly true with the stock flat on the year, below its pre-pandemic pricing, and looking attractively valued right now. The stock is trading hands for a forward price-earnings ratio of 13.8 based on the midpoint guidance for this fiscal year's earnings per share. That's a very low price-earnings ratio in this market. Also, the stock's price-to-cash flow ratio of 18.5 is lower than its own 5-year average of 19.1. And the yield, as I showed earlier, is significantly higher than its own recent historical average. I valued shares using a dividend discount model analysis. I factored in a 10% discount rate and a long-term dividend growth rate of 7%. This dividend growth rate is basically right in line with the company's demonstrated dividend growth rate over the last 5 years, including the most recent dividend increase of 6.6%. I'm modeling in a minor acceleration off of those recent numbers. As the payout ratio is low, the 10-year earnings per share growth rate is in the double digits, and CFRA is expecting a near-term earnings per share growth rate of 10%. I don't see the 7% dividend growth rate as an unreasonable hurdle for the company to clear. If anything, it's on the conservative side. The dividend discount model analysis gives me a fair value of $92.73. The reason I use a dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow growth. It then discounts those future dividends back to the present day to account for the time value of money, since $1 tomorrow is not worth the same amount as $1 today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates Merck as a 4-star stock with a fair value estimate of $94. CFRA rates Merck as a 4-star buy with a 12-month target price of $90. I came out right in the middle, but we're all in general agreement here. Averaging the three numbers out gives us a final valuation of $92.24, which would indicate the stock is possibly 21% undervalued. Here's the bottom line, guys. Merck Co. Inc. is a high-quality company across the board. It's perhaps positioned as well as it's ever been, with a market-beating yield, a low payout ratio, inflation-beating dividend growth, 10 consecutive years of dividend raises, and the potential that shares are 21% undervalued. This could be one of the best deals in this market for dividend growth investors. And now for a special news announcement. Enbridge Inc., stock ticker ENB, is making plans to start moving crude via its new Line 3 pipeline after recently winning a number of favorable court rulings in Minnesota after years of court battles and regulatory hurdles. I highlighted Enbridge as a high-yield opportunity for long-term dividend growth investors in May, and the developments with Line 3 only makes the business more attractive. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also take a look at the description box below for some important links, including the link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I made my portfolio entirely accessible over a Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is, and I'm often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who have been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.